Welcome back to another insightful session with Informed Investor. India has seen a rapid change in the business environment in the past few years, and companies adopt some bold strategies to stand strong in the ever-changing business environment. Can you guess which powerhouse made the boldest moves? We often hear in the news about companies adopting different strategies to adapt, to gain a bigger market share and even achieve economies of scale. We often hear about two companies coming together and becoming one enterprise, or one big fish swallowing another smaller fish. Let's do something interesting. Can you guess which was India's biggest merger? I'll give you a clue. It's in the banking industry. Yes, it's the mega merger of the HDFC Twins. Okay, let's do another one. This very merger materialized on the big screen. I hope you've guessed it. It's the merger of the two pioneers in the media and entertainment industry, with PVR Cinemas and Inox Limited coming together as one. In financial terms, this is referred to as mergers and acquisitions. It's like a corporate version of joining forces or survival of the fittest in the business jungle. In this video, we'll discuss about mergers and acquisitions and the different types that exist with examples. We will also ponder upon why do companies resort to mergers and acquisitions and what benefit it brings for both. We will look at the trend of M&As in India and summarize the recent and the biggest deals that have happened in the country. Let's begin. You're watching Informed Investor and initiated by Research and Ranking. Mergers and acquisitions are strategic alliances between two or more companies. These are strategies that companies adopt to grow inorganically. Now you might wonder what I mean by inorganically. So organic growth is internal growth, or growth that comes from expanding operations and engaging in internal activities that increase growth, whereas inorganic growth comes from mergers and acquisitions and joint ventures. Now coming back to the main topic. So a merger is a combination of two or more businesses resulting in the creation of a new enterprise. It's a transaction where two or more corporations pool their resources and operations and combine to form a single corporation. Let's understand this through an example. So back in 2018, Vodafone merged with Idea Cellular to form Vodafone Idea Limited to get a deeper penetration and market reach through the merger. Though it initially worked and got a good subscriber base in the telecom sector, the financial troubles with debt piling up and the advent of Mukesh Ambani's Jio soon led to the merged entity's supremacy fade away. Now on the other hand, an acquisition means a process by which a company purchases another company or gains a majority shareholding in the company. Or in simple terms, when a larger company takes over or acquires a smaller company, absorbing all the assets and operations of the smaller company. Let's take an interesting example for this case. In early 2022, Elon Musk acquired social media platform Twitter for $44 billion in a hostile takeover. To put this into context, friendly acquisitions are those when both parties willingly participate and have mutual consent for the takeover. In case of Twitter, it was a hostile takeover. Let's run through these events quickly. In April 2022, Elon Musk bought 9% shares of Twitter on the open market and wishes to acquire Twitter for $44 billion or $54.20 per share. While the offer was welcoming, the plans that Musk had for Twitter did not sit well with the staff and board members. And this is when Twitter adopted a defense mechanism known as poison pill. In simple terms, poison pill is a strategy used by the board or directors of the company to prevent investors, competitors by taking control of the company by accumulating more shares, so any outsider like Elon Musk cannot take over the company by holding a majority of shares. So then starts the battle in the courts regarding the presence of fake and spam accounts with Musk's intention to not buy out Twitter. Eventually, after several court hearings, in October 2022, Elon Musk acquires Twitter for $44 billion and promptly fires key executives including CEO Parag Agrawal. So why do companies engage in M&A activities? By combining two companies, the resulting entity can cross-sell products or services to each other's customers, expanding into new markets or eliminating overlapping costs. Companies resorting to M&A can utilize economies of scale by sharing resources such as manufacturing facilities, distribution channels, or back office functions, which can lead to lower cost per unit of production. Companies can enter new markets or expand into existing markets quickly and efficiently by acquiring companies already established or with the necessary technology expertise. Companies can acquire other companies to eliminate competition and eventually capture a larger market share. In addition to these reasons, companies also engage in M&A activities for other reasons, such as to acquire a company with a strong brand or to acquire a company with a valuable customer base. So what has been the trend of M&As in India? The M&A market in India is growing and becoming more mature. As seen in the chart, the value of deals rose consistently and peaked in 2022 at $164 billion, growing at 65.5% from the previous year's $99 billion. This was fueled by the mega mergers of HDFC Twins and Adani's acquisition of Ambuja Cements from Holcim. However, the year 2023 was filled with challenges as it dropped to the lowest in 8 years to $50.8 billion, a decline of 69%. The challenges were attributed to rising global interest rates, geopolitical tensions, and economic uncertainties. Coming to our last segment, let's look at some of the recent M&A activity in the country. Let's start off the list with a merger that sent shockwaves through the financial world. In a bold move, these two mega powerhouses of the Indian financial sector merged on July 1st of 2023. HDFC Limited and HDFC Bank merged together and became one single entity, which is HDFC Bank. To put this into context, HDFC Limited basically is a housing finance company, which means it indulges in lending loans for houses, and more importantly, it was a parent company of all HDFCs, which encompasses several subsidiaries. Whereas HDFC Bank was a subsidiary and had a banking license, which means it operated as a bank accepting deposits, giving out loans to retail and corporate investors. So anyway, this mega merger of $40 billion is termed as the biggest transaction in the history of India. HDFC Bank now trades at a market cap of 12.32 lakh crores, or about $151 billion, making it the 7th largest bank, bigger than the likes of giants like Morgan Stanley, Goldman Sachs and Bank of China. When compared to the domestic players, HDFC Bank stands at the second spot with a loan book size of 22.3 lakh crore, with SBI topping the list with a massive 31.1 lakh crore of total loan book size. So being the second largest bank by lending size, the merger will make HDFC's presence heavier in the mortgage or home loan segments, contributing 33% of the loan breakup. A few other interesting facts are that the new HDFC Bank entity will have around 120 million customers, greater than the population of Germany. It will also increase its branch network to 7,945 and boast a total headcount of more than 180,000 employees. Notably, close to 70% of customers of HDFC do not have an account with HDFC Bank. Conversely, only 2% of the customers of HDFC Bank own a product of HDFC. So what are the benefits of this merger? This merger will result in several synergies like expanded product portfolio, access to a wider customer base, operational efficiency, enhanced financial stability, further reinforcing its market position and potential for growth. The next merger was a huge development in the media and entertainment industry. As we know, one of the most affected sectors after COVID outbreak was the cinema industry. And to further add to the misery was the advent of the OTT platforms, which was perceived as a significant long-term competitive threat to multiplexes. And that's when PVR Limited and Inox decided to join hands together, merging themselves into a single entity known as PVR Inox Limited on 6 February 2023. Prior to the merger, PVR boasted 934 screens and solidified its position as the biggest multiplex player in the country, while Inox on the other hand had 755 screens, making it the second biggest multiplex player. Post-merger, it brought a host of benefits, making PVR Inox the market leader in terms of screen count in India, with 1,702 screens spread across 115 cities. When looked at the financials of the first half of the year 2024 as compared to the previous first half, total income grew 25%, while the EBITDA had a healthy growth of 23%, and the profit after tax grew a staggering 155%. So what are the benefits of this merger? This merger will command a significant market share of around 49%, consolidating the market, thereby bringing a host of benefits like a deeper reach in Tier 2 and 3 markets, cost optimization, thereby boosting profitability. In fact, due to the merger, in the recent Q2 results of fiscal year 24, it saved about 4 to 5% of overhead costs and increased the overall box office revenue by 8.7% to 9.7% due to the synergy. Furthermore, it boasts about being the 5th largest multiplex chain globally by screen count. All in all, though the merger bodes well for PVR Inox, the industry still faces competition from OTT platforms, posing a significant threat to the cinema industry. Next up is an acquisition which can be called as the hostile takeover by one of the billionaires in the country. The Adani name has gained a lot of attention not only in the country but even internationally for several other reasons, which we can keep for another separate video if you are interested. So anyway, let's begin and take you through the timeline of events of Adani taking over NDTV. So back in August 2022, Adani Group acquired a 29.18% stake in NDTV through a deal with VCPL. To put this into context, VCPL had loaned around 403 crores to NDTV company, in which VCPL could convert the debt into equity shares. And when Adani acquired VCPL, it converted the debt into a 29.1% stake in the news channel. And this is why viewers consider this as a hostile takeover, as it acquired a significant stake without discussion, consent or notice. So anyway, back to the story. Armed with 29% of indirect stake in NDTV Limited, Adani Group launched an open offer under SEBI norms to acquire an additional 26% in NDTV. So in September, Adani Group acquires an additional 8.26% stake, bringing its total holding to 37.45%. Further, in December 2022, the promoters of NDTV, Pranay Roy and Radhika Roy, intend to sell a 27.26% stake in NDTV to Adani for 602 crores, retaining a mere 5% in the company. And with all of this, Adani becomes the biggest shareholder of NDTV, increasing its shareholding to 64.71%. And through all of this, NDTV shares have had a bumpy ride, soaring as much as 393%, reaching an all-time high of rupees 519 on the back of the acquisition. However, post the acquisition, there were several factors that led to the stock price slumping, like investor uncertainty, as investors were unsure how the acquisition would impact the company's editorial independence. Second were the concerns surrounding debt, as Adani Group is a highly leveraged group, with investors fearing that Adani might prioritize debt repayment over investing in NDTV's growth. And lastly, competition from other media companies, with established players and new digital entrants eyeing market share in the ever-evolving media industry. In conclusion, media is a force in India, and the ownership of media becomes all the more important, since owning it means you have control over how things, policies, people and politics are perceived. Previously, Adani Group had picked up a 49% stake in Bloomberg Quint's publisher, and interestingly, as we talk today, BQ Prime has now become NDTV Profit, surprising quite a few viewers. With this, it further strengthened its presence in the Indian media industry. There have been substantial changes in the commercial aviation in India, and the next few years could turn out to be the most interesting for Indian aviation. Less than 2 years has passed since Air India was given back to its original owners, the Tata Group. It has been quite a journey for the flag carrier of India. In 1932, Tata Group founded Air India. In 1950s, the government took control of it, and Tata finally acquired it back last year. Under the new management, the Air India is getting a complete makeover. After merging low-cost carriers like Air Asia with Air India's low-cost subsidiary Air India Express, it is also moving towards merging its two other full-service airlines, which is Vistara with Air India. Soon after the proposed Vistara Air India merger was announced, many frequent flyers of Club Vistara were disappointed, as it was learned that the Vistara brand was ceased to exist. Air India undoubtedly had a huge potential to grow as a brand, but coming to reality, it is an airline which has been underinvested for many years now. Vistara offered an experience which no other Indian airline offers, and Air India, to match that level of service, it would likely take a few more years. In response to this, Air India's MD and CEO, Mr. Wilson, said in an interview that Vistara would continue to operate under its own name until they feel that Air India is ready for it. So what does this mean for the aviation industry? The aviation industry is headed towards a duopolistic structure, with Air India and Indigo making up more than 80% of the market share. As of October 2024, Indigo emerges as the front-runner, boasting an impressive market share of 62%. What makes this even more noteworthy is that no other carrier comes close to reaching a double-digit market share, highlighting Indigo's dominant position in the market. Following Indigo is Air India, which takes the second spot with a 9.5% market share, while Vistara follows closely at 8.7%. Air Asia India secures the fourth position with a market share of 7.57%. Notably, the Tata Group of airlines, including Vistara and Air Asia India, holds a consolidated 25.93% share. To sum it all up, mergers and acquisitions are not just financial maneuvers, but strategic moves shaping India's business landscape. They can drive innovation, efficiency, economies of scale, market dominance, and consolidation in the industry. But this also comes with challenges. As the economic landscape in India continues to evolve, we can expect more M&A drama in the years to come. Having said that, this is me, Ralison, signing off. Have a great day and stay safe.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.